Imagine you've built a portfolio worth $70,000. You've learned how to think like a business owner. But owning one great investment isn't the end of the journey. The next lesson is understanding balance. Great portfolios aren't built on a single investment. They're built on investments that work together. The goal isn't to predict the future. It's to prepare for different possibilities. That's where diversification begins. Imagine putting all of your money into one investment. If that investment performs well, your portfolio grows. But if it struggles, your entire portfolio feels the impact. That's known as concentration risk. Diversification doesn't eliminate risk. Markets can still rise and fall. But spreading your investments can reduce the impact of relying on just one company, one industry, or one asset. Many experienced investors prepare for uncertainty rather than trying to predict it. Diversification isn't about owning as many investments as possible. It's about owning investments that serve different purposes. Some are designed to pursue long-term growth. Some may help provide stability. Others offer flexibility when opportunities appear. Think of your portfolio as a team. Every player has a different role. A stronger portfolio isn't built from identical investments, it's built from investments that complement one another. Many long-term investors don't begin by searching for the next winning stock. Instead, they begin with broad diversification. One common approach is investing through index funds. An index fund aims to track the performance of a market index by holding many different companies. Instead of relying on the success of one business, investors gain exposure to many industries across the economy. This doesn't remove investment risk, but it helps avoid depending on a single company for long-term success. For many investors, this becomes the foundation of a diversified portfolio. Not every investment has the same purpose. Some are designed for growth. Others help add stability to a portfolio. That's one reason many investors include high-quality bonds. A bond is essentially a loan made to a government or a company in exchange for interest payments over time. Bonds can still lose value. But because they often behave differently from stocks, they may help balance a portfolio during changing market conditions. A resilient portfolio isn't built from one investment. It's built from investments that work together. Another asset many investors consider is real estate. Productive real estate can generate rental income, support businesses, and provide diversification. Some people buy properties directly. Others invest through real estate investment trusts, also known as REITs. Like every investment, real estate carries risks. Property values can rise or fall. Rental income can change over time. But for many investors, real estate adds another layer of diversification within a long-term portfolio. Many people think cash is doing nothing. But cash has an important job. It provides flexibility. It helps cover unexpected expenses. It allows investors to take advantage of opportunities without selling long-term investments. Holding too much cash for many years may reduce purchasing power because of inflation. Holding no cash at all can reduce flexibility. Like every other asset, cash has a role. The key is finding the balance that fits your financial situation. By now, you've seen that every investment serves a different purpose. Businesses can provide long-term growth. Bonds may help improve stability. Real estate adds another source of diversification. Cash provides flexibility. None of these assets needs to do everything. Their strength comes from working together. A portfolio isn't just a collection of investments. It's a system designed to help you navigate different market conditions over time. Building a portfolio isn't a one-time event. Over time, some investments will grow faster than others. That changes the balance of your portfolio. Many long-term investors periodically review their investments and rebalance when needed. Rebalancing isn't about predicting the market. It's about maintaining the level of diversification and risk you originally planned. Successful investing requires more than choosing investments. It also requires discipline. If there's one lesson to remember, it's this. Building long-term wealth isn't about finding one perfect investment. It's about building a portfolio that can adapt to different seasons of life. Productive businesses, diversification, thoughtful risk management, patience, and discipline. Markets will rise, markets will fall. But a carefully designed portfolio is built with the long term in mind. Keep learning, stay diversified, invest with purpose. My name is Marcus. Thank you for joining me for another lesson on Money Secret TV. I'll see you in the next episode.